and welcome to the podcast Ramp Up to Retirement with your host, Dan Reese. Dan, good to be with you again. How are you?
I'm doing great. Good to see you, Bill.
It's good to see you as well. I'm very excited because as we're recording this one, we're not quite to the correct day of spring, but we are at least, like they say, we're at the meteorological definition of spring. So hopefully warm weather's in our future.
Noticing the days getting a little longer, which is nice. You know, it's tough when it's dark when you go to work and it's dark when you go home, and I think everybody gets tired of that. So good to see some extra light.
Yeah. So speaking of extra light, what are you shedding some light on today for us?
Yeah, we got a great topic today. We're going to be talking with Brent, one of our senior wealth advisors here at Avery Wealth, about 8 blunders to avoid in retirement, which we laugh about that because, there can be lots of blunders, but we're going to try to focus on 8 that we feel are important and shed some light on them because, a lot of times the danger is in the things you don't know, right?
Yes.
So hopefully we can shed some light on some of those and enlighten our listeners.
Terrific. Well, I'm all ears.
All right. So, Brent, how you doing?
I'm doing great. I'm really looking forward to this topic because, Dan, as you know, this is our wheelhouse. It's not kind of our wheelhouse. This is right where we live, every day. And I feel like this is where we bring a ton of value, is just helping people be successful in retirement. And that's what we're gonna talk about, things you can avoid so that you can be successful in retirement today.
Yeah, and we've talked a lot about that. It's funny, a lot of things in life, there's the things that you do that bring you success, right? Obviously, like saving money, funding 401ks, all those things. But a lot of times, especially for success, it's as much of the things you avoid, right? Or you basically don't make that mistake, and that's kind of what we're going to get into today.
Yeah, I think that's a great point. And so one of the things that I would ask you to try to look for if you're listening to this podcast is just, we think there's really 3 key areas, and I think the 8 blunders that we're going to talk about all fall into these 3 things. And we talk about wanting to have your investment foundation set up to help you achieve what you're trying to achieve. That's going to be the foundation of your plan, and that's super important. And then after that, so that's like one lane we talk about. Another lane would be, okay, now we have that foundation to help us retire and do the financial planning piece, which is all these what if scenarios, like all the different things that you want to do in your plan, right? Those are your goals and all those types of things. And then you have to figure out a way to get that money out, and we want to make sure that we do it in a really tax-efficient manner. And so investment management, retirement planning, and tax or distribution planning is going to be the key kind of in all of these 8 areas. They'll all fall, some of them fall in multiple of those areas, but I think that's a really good place to start, is that's kind of how we want everybody to look at these things.
Yeah, that's a great point, because I think that overriding theme, it does help. It's kind of the vision, right? Making sure all those things are addressed, super important. So as we dig into these, I think it's good to keep those in mind. That's a great point. So let's just jump into the first one, which, I think a lot of people, we notice this as people are getting excited about retirement, the idea of, hey, I don't have to go into work again, every day like I have for many, many years. And so sometimes that excitement might drive them to not think of all of the expenses, right, that could be out there in retirement outside of the regular everyday living expenses that we all think about. Can you talk to that a bit?
Yeah, for sure. I mean, a lot of times people will just go with the base, like what are my just living expenses? And so, a lot of times they forget about important things like maintenance of your house, maybe it's taxes or insurance, things that you don't pay maybe every month. Those can be often forgotten about. And then there's things like, you're going to have more time on your hands, hopefully, to do the things that are important to you. So maybe that's traveling, maybe it's some type of a hobby. And I think a lot of people will underestimate those expenses, or they'll fail, to really inflate them moving forward, which can be another big things. And so everybody's different, right, Dan? So we don't know Some people maybe spend more early in retirement and then less. We've talked before maybe on this about the go-go years, like early in retirement, like you're doing all these types of things. The next period of time might be more of a slow go where you're not traveling maybe as much. And then you get to a point where maybe you don't go anywhere, and we'd call that like the no-go years. And so everybody's going to be different when it comes to that, but maybe in the no-go years, maybe you have health care that creeps up. And so it's really important that you're including all of those expenses and not missing things.
Yep, I think it's a great point. Going back to what you said, it's like that, it's easy to calculate your normal monthly expenses, but like what you learn, obviously, is no month is normal. It seems like, because something might come up with the house, something might come up you want to do for your grandkids, whatever, right? So that's really good stuff. And
and I think just even going back, sorry, Dan, but even going back 12 months, so instead of just looking at, well, what did it cost me last month to live? If you go back over a period of time, you can really have a good idea of the things that you're spending money on that maybe you wouldn't have accounted for. And then you want to add in the things that you're trying to do, like those goals and so forth.
Yeah. Anytime you own a house, stuff pops up. Like that's the thing. It's like, I know a lot of people try to get all the big projects done before retirement, but it is shocking, the stuff that'll just pop up along the way. So it's really important to include those things. And you mentioned, as we go into number 2, which I think is a big one, you kind of mentioned in what we call the no-go years, oftentimes later in retirement. But this can really happen anytime, especially maybe right when you first retire, is underestimating the cost of health care, right?
Yeah. Fidelity recently did a study, and it showed that the average person, so this isn't even a household, this is a person, they estimate a 65-year-old retiree will spend $165,000 in today's dollars in estimated healthcare costs. So, that's quite a bit of money that I think a lot of people just aren't accounting for. And then what we do when we run projections is we inflate those at a much higher rate than we would your regular living expenses. So we're using around 5.5% on healthcare and closer to 3% for your regular living expenses. So if you took $165,000 and inflated that at 5.5%, you're talking about a huge amount of money that you really, really need to account for. And then if you're retiring before Medicare age, a lot of times families don't realize how much health insurance costs before you reach Medicare age, and we usually use about $10,000 a person. So if there's 2 of you, you got $20,000 a year in expenses. That's in today's dollars as well. So it's really, really important that you're thinking these things through, and that you're making plans. Saving in health savings accounts, doing things like that to make sure that you can do the things you want to do and you can retire when you want to.
Yeah, that healthcare is such a huge one, because I think it is underestimated. And part of that is, I think, and we've talked about this, is that so many times the majority of Americans have that kind of a paycheck deduction for the portion they pay, and it's not really in their face, right? Because It's like they get used to their take-home income and all that. So really, that's a great point. And you actually, I think, gave a little bit of a bonus blunder when you mentioned inflation, because that really over 25 years is significant, right? So that's kind of the bonus, which I just noticed listening to your answer there. So great job.
Yeah. You can't forget that. You can't forget it on your living expenses, and you certainly can't forget about it in your when you're projecting out health care. Inflation, as unfortunately as we've learned over the last few years, is a real expense that if you don't account for it, it's gonna really derail your plan a lot of times.
Yeah. And the next one, I think is great, because, the idea for many years was, man, I can't wait to get to retirement and I won't have taxes anymore. Like my income will be lower. I don't have taxes. But number 3 is inadequately accounting for taxes, which I think is really, really important, because we found that can be a major blunder, right?
Oh, without question. I mean, I don't know about you, Dan, but I have not met with very many people who think that their tax situation is going to get worse or it'll even be equal when they do retire. And you touched on that. So this is a huge area, and it's I look at it as a real opportunity for you to make really good decisions in retirement. But like Social Security, tax, all these different areas. Like, how do you use your different buckets of money in an efficient way is one of the keys to making sure that you are tax efficient. And we do all kinds of different strategies here. One comes to my mind right now. I'm working with a family that's in their late 60s and they're retiring, and so initially when I met with them, they just look at this, hey, the next few years we're not going to have to really pay any tax, and it's interesting because I think that's the default that a lot of people go to, and this is where the blunder occurs, is that they will take advantage of a year or two and pay almost no tax, right? And then what happens down the road is they're forced to take money out of their retirement accounts and their tax rates go way up. So we were able to actually, with this family, for a couple of years, we prepaid taxes. And what it did is it saved them around 300. What we're projecting is that it's going to save them probably around $350,000 in lifetime taxes. And it's going to help them avoid some other unknown taxes like Medicare surcharges and things like that down the road. So, they're saving probably around $400,000 in their lifetime by prepaying taxes. And most people don't consider that. They just plan for the year that they're in instead of having a long-term tax plan that's going to help them, minimize taxes over their lifetime.
Yeah, that's great. I think, but a lot of people are probably scratching their head saying, how could it be that much? But, it's funny. We talk about compounding our investments, right? That's like, it's, one of the, eighth wonder of the world is compounding.
Yeah.
Sometimes people forget that if you have accounts you've never paid taxes on, the taxes also compound, right? So like if you're not proactive. So that's why sometimes those numbers can get really big, which is a great point. When you're proactive, that can make a huge difference. So good point on the taxes. So let's move on to number 4. And this is a good one because sometimes this happens without your consent, if you will, which is failing to adjust your financial plan when retiring earlier than projected. And so what I mean by that is sometimes we get forced to retire, maybe for health reasons or downsizing or whatever, right? More than we thought or earlier than we thought. So can you talk about that point?
Yeah, I mean, I think that's a great point. Is like no one knows the future, right? I mean, we can plan all we want, but sometimes, you're just like you touched on. Maybe there could be a health situation. Maybe there, a loss of a job. Who knows what the situation is? And you just want to build flexibility into your plan. And a lot of that has to do with some of the things that you're doing leading up to retirement, and in your working years to make sure that you have diversified buckets of money, so different tax consequences of money to make sure that you can get income in an efficient way if the unexpected happens. And so you just want to make sure that you are building flexibility into your plan and that you have backup contingencies, right? We do that when we build things and you're building a plan, right? So when you're building a plan, you want to make sure that you have that contingency in place and that's well thought out and can handle the unexpected.
Yeah, and I think that's a good point. Just a plug for getting into a certified financial planner a little earlier than right before you're going to retire, because a lot of times you can get the assistance in building out more flexibility on that, right, Brent? Versus just waiting until the last minute.
That's a great point, Dan. Like, we talked about right at the beginning of this. I'm excited about this because this is right in our wheelhouse. This is what we do, and I think if you're 5 years from retirement and probably somewhere in that 5 to 10 years out, you really should be meeting with somebody, coming up with plans, because if you say you're 10 years out, you may not be 10 years out, just like what we're talking about here. That may come up sooner, and we need to make sure that we're building those contingencies into your plans so that you can be successful.
Yeah, great point. Great point. Number 5 is really interesting because I think this has become more of a thing in recent years, but it's funding unbudgeted expenses for loved ones. And the reason I say that is like I've noticed, and you're going to obviously speak to this, but a lot of people will say, "Oh, I'm retiring. I told the kids they're cut off." That's sometimes easier said than done, isn't it?
Yeah. I mean, and it's wonderful if you're in a spot to be able to help your kids or your grandkids. But you want to make sure that you're putting yourself in a really good, solid position, in that it's a sustainable thing. And then you want to, if that's your goals, is to help others, then that's where that would happen. But just like what we talked about previously, the unexpected happens, and like you're a parent, I'm a parent. We want to be able to help, but we can't do it at the expense of our own situation, because what'll turn around and happen is like you end up living. Like, you didn't really help them if you live in their basement, when later on in life. Like, no one wants to do that, right? So you need to make sure that the things that you're doing aren't going to derail your own plan, because it's really not helping anyone.
Right. That you're talking to that contingency fund, obviously, for things that you don't know. And we talk about kids and grandkids, but parents even, right? Sometimes parents need assisted living or care. And you're not going to see, I don't know about you, but I do know about you. You would never let your parents suffer, right? You're going to help them.
Right.
And that's how most of us feel. And so that can be something that you don't really think about happening, but it's a reality.
Yeah. And a lot of times, like you said, those are questions that are important to consider, and things that we talk about when people come in are there other people that, are going to be dependent on you, right? And maybe that is their parents, or maybe it's your kids. Everybody's situation's unique. So if we know those ahead of time, it's a lot easier to plan for those things, and make sure that spending in the current day is appropriate, so that you can do those things in the future.
Yeah, great point. Number 6 is fun, kind of, because I don't think I've ever had a client come into the office and say, I'm pretty much, I think I'm living till 100, right? Like, most people are like, I'm probably not going to live that long. I got this, I got that. But number 6 is really underestimating your longevity. So talk to that point.
Yeah, it's just like anything else. Like, no one knows the future, right? We don't know what's going to happen. Certainly, you can look at your family tree a little bit and get an idea on this, but that doesn't build any real certainty into your plan. That's not in our hands, right? That's in God's hands. And so I think it's really important just to make sure that your plan is sustainable. We usually are in the mid 90s is what we're building plans out to. And, I think you're the same as me. I like to see a plan that's, everybody maybe wants. I don't know if everybody wants this. I've heard people say, I want my last check to balance out. Like, that would stress me out. That's probably what would kill me, is seeing my net worth decline to that level. But I've heard people say that before, but it doesn't really work that way in the real world. Is we want to see something that's at least maintaining, if not growing throughout retirement, because of the unexpected things that can happen. And so when you short sell that, like, oh, I'll never live this long or whatever, it's probably gonna hurt you in the end. So you always want to make sure that you're thinking that through.
I think that's a good point, and sometimes people use that almost as a crutch to say, well, I'm going to make this decision because I'm only going to live till 75 anyway. Well, yeah. You got to be really careful with that, because, that could be the case, but you don't want to be 76 and being, oh, crap, I live past 75 and now I've got no money. So real important. Yeah. But
that's a similar thing to, somebody saying, well, I'll never be able to retire. Well, you probably will be able to if you're willing to sacrifice some of today, right? And a lot of those decisions that you have to make when you're considering a longer life, it may be sacrificing some today to make sure that you have the resources to live later on in life, and that's why your plan needs to account for it.
Yeah, good point. And number 7, I think, is really interesting, because Social Security is such a great resource, right? But a lot of people don't fully understand the power of it. and sometimes don't make really educated decisions on how to take it because of that. But blunder number 7 is relying solely on Social Security to cover your living expenses. That's something that might be a bit of a challenge, right?
Yeah, I mean, it's really not designed to do that. Social Security is a supplement, to your other savings. But if you're counting on living on that alone, it's probably not going to work out very well for you. And so you want to make sure that you're considering Social Security as your own money, and I think that's a very important part of this. And what I mean by that is that you have all these resources when you're in retirement, right? Hopefully you've been a good saver and you have a 401k or 403b, maybe a pension if you're fortunate, in other investments, maybe a Roth IRA. And Social Security is a piece of that. And you want to make sure that all of those things are in alignment and that you're using each and every one of them to help you achieve the things that are most important to you. And that's really how you want to rely on Social Security as a part of your income plan. It's not designed and it's not going to be sustainable if that's your only means in retirement.
Yeah, that's a really good point. And one other quick point, because I've heard this a lot lately, and it's something that I think is a misunderstanding around Social Security, is a lot of people think the day they retire, they need to start it, right? They don't need to. They have choices, right, Brent?
Yeah, that's a great point, Dan. And that's a little bit what I was alluding to, is that if you're thinking about it as your own money, obviously the longer you wait up until the latest that it makes sense to wait to take Social Security is at you're 70, but your benefit keeps growing as you put off that decision. And not always, but a lot of times it makes more sense to allow that to grow and maybe use some of your other sources. And it's hard for people to do because they see, well, this is my money that I saved, and they don't think of that as their money, the Social Security benefit, as their own money. And it's very important that you do that because it is one of the pieces of your retirement plan and your income plan. It impacts so many things, including taxes in retirement. The way that you take that can really make a significant difference in your sustainability.
Yeah, really good point. And the final one we're going to talk about, which is forgetting about required minimum distributions, also known as RMDs. And so I'll be the devil's advocate. What's the big deal? Like, yeah, at some point I have to take some money out. What's it matter if I just kind of put that in the back burner until the time comes?
Well, that's where the real blunders can happen. Quite honestly, is when I understand why people have that approach. It's like, well, a little bit earlier I talked about tax ramifications, right? And so with the couple that I gave the example on, they could have had a couple of years where they didn't pay any income tax because they could have lived off of other money that they had and allowed those funds to grow. But what happens is when you're required to take money out, it has to do with IRAs, basically 401ks, 403bs, money that's in tax deferred accounts. You're required to take that out at age 73. And it's based on, in simple terms, it's based on how much is in the account. The more of the money that's in the account, the more that you have to take it out. Well, one of the things that happens is that's all taxable as income. And so if now you stack your Social Security benefit and any other income that you have coming in, you may be in a spot where you're getting way more income than you even need in there. And people are like, well, that wouldn't happen, but it does happen. And we see it all the time. And that's, people would be like, well, I can't have too much income but they're not thinking about it in the same terms. Like when you're working, you can't have too much income, right? Like just let's keep growing that. But in retirement, you have goals, you have things, a lifestyle that you're trying to maintain, and so you have a need of income. Well, if you're getting way more income than that, you're just not tax efficient at all. And so there's ways that we can, before this happens, that we can help you become tax efficient. But if you're forgetting about that this is going to happen to you, and you're just kind of kicking it down the road, that decision to take the money out, it's probably going to blow up on you. And so it's really, really important to consider your required minimum distributions when you're creating your initial and future income plans in retirement.
Yeah, great point. And I think one of the things too, you might have mentioned it earlier, but sometimes when you get to that point and you have too much income, you may find your Medicare premiums also change, correct?
Yep. So yeah, that can all those things are in play. And I mean, it's basically a tax, right? When you're a Medicare surcharge can really, they get really expensive. And so you have to make sure that you're planning that out. And once you get to that point, it becomes very difficult to do it once you reach that age. And that's why planning is so very important ahead of time to make sure that you're aligning all this together.
Yeah. This has been great. So 8 really good blunders to consider. And this report, we'll put a link in the show notes, but this is something you can download from our website, which kind of gives a summary of each of the things we talked about. So I know listening to it, sometimes you pick up pieces, but this gives you the opportunity to download that and be able to look at it point by point, maybe kick in some of the things we talked about as far as remembering what those points were. So really great information, Brent. I really appreciate it today.
Yeah, thanks. It's been fun talking about these topics. I mean, like I said at the beginning, I mean, it's so important. So important. I'll go back to it again, like those 3 lanes, your investment management, making sure that your investments are aligned with the things that you're trying to achieve. And then you want to make sure that your financial plan, the goals that you have are sustainable moving forward. And then you have to consider tax. And I think we talked about all those different things together, and we can really help people make really, really wise decisions in retirement. But I would get started early, like we talked about.
Great point.
Good stuff, guys. Good stuff. It's funny listening to you. I was sitting here thinking about, people do generally consider taxes. I think the 2 things that people don't consider that often, they just don't figure it in, is when they're building their retirement budget. They don't account for inflation, and that became really clear. I live in New Jersey. And everybody in New Jersey got an email, got them in the mail. They got were warned that their electric rates were going to go up 20%
Wow.
in June. All right, this is what the state has done to us. And I kept thinking, wow, I bet nobody sat down and put 20% increases into their, just little cost of living things, and I'm sure as well. Nobody thinks about the increased medical cost, because I think that's a really, really good point, because whether we want to or not, we all spend more as we get older on our our health, because it demands it, right? And you must see that all the time.
Well, and I think people get frustrated, like in general. Healthcare is a very explosive topic, if you will, because, people really don't like the idea of having to pay for healthcare. I mean, in all honesty, like it's like they feel like they don't necessarily get the value they should out of it, or whatever it might be. And so oftentimes it is something that they don't think as much about, right? So, real important.
And I would say a lot of people aren't used to paying for it. If it's just in their paycheck. I think more and more people are becoming familiar with it because they've seen, their deductibles go up or things like that. But when you get into retirement and you're going to retire early and you don't have any health benefits, and now all of a sudden we have to put a line item in there for $20,000 a year out of pocket for insurance premiums and deductibles and other out of pocket costs. Yeah. And then you start inflating that out. So if you retire, say somebody retires at 55 years old, you start inflating that out at 5%, and the number is massive. And so it's just, if you haven't accounted for that, you are setting yourself up to fail, because it grows in a heartbeat. It's unbelievable.
Yeah, which underscores for me and underlines the importance of having a financial advisor that people can talk to. So if anybody's listening to this podcast, Dan, and are thinking maybe they want to reach out to you to have a conversation with either you or Brent, how do they do that?
Yeah, I mean, they can always call us, 517-783-1695. But, like I said, I think I've said before, the best thing to do is just go out to our website, averywealth.com. There's a contact us button there. You can always call us. You can shoot us an email. We'll reach right back out. And there's tons of really great things out there, just like this checklist, under our Insights tab. So you can go through. There's things on business planning, retirement planning, taxes, the markets, everything you can imagine. And it's updated regularly. So there's always really great things out there, because I know a lot of people want to just continue to learn. And sometimes it's, it takes a little time to be comfortable calling someone and asking those questions. But my best advice to you is don't ever be embarrassed. Like, a lot of people are like, well, I haven't done the best things, and they feel bad about it. And it's like, who cares? Like, life's about moving forward. It doesn't matter what's happened in the past. Move forward and make good decisions. And it's Brent made a comment about people saying they could never retire. The reality is like most people, if they get serious about it and they're willing to put in some work, they can make great progress in with just a few years. So that's our best advice for anyone out there listening.
Yeah, and I would say to those people, Dan, who feel like, well, I made some bad decisions, or maybe I haven't done what I should be doing, or whatever. Look, you are not alone. You are. No, all of us have not made good decisions and could have made better decisions, and so no. And the other thing I want to emphasize is, if you do reach out to Dan or Brent, it doesn't obligate you to do anything.
Right.
It's like, it's a conversation. And, right?
Yeah, we talk to people every day. Like we have a lot of our clients that'll say to their friends, hey, give Brent a call or give Dan a call, if you've got this question around some financial issue. And, it's not a lot. Most of the time, it's not around investments. It's actually around other things, right? Like, maybe selling a house or refinancing, or unfortunately going through a divorce, just different questions about things. And as certified financial planners, we have knowledge around a lot of areas of finance, not just investments. And I think it's great, to just reach out and get some good answers. And we'll be the first to tell you, Brent and I both, that if we don't know it, we'll find it. But we'll tell you if we don't know the answer right away, because I think it's important that there's that credibility there. We're not just going to give you something to appease you at that given point in time. So
fantastic. So if you're listening and you feel like giving them a call, please do. The other thing you can do that doesn't involve you doing anything other than hitting a button is become a subscriber. If you're not a subscriber to the podcast already, reach out and hit that follow button, hit that subscribe button. The reason that's important is that when Dan drops new episodes of his podcast, you're notified and you can give it a listen. And I would ask you that if you like this podcast, if you find it helpful, you find it useful, you find it informative, tell people about it. Share it with other folks. Word of mouth promotion is an invaluable tool, and we would very, very much appreciate it. So until next time, I'm Bill Tucker. On behalf of Dan and everybody at Avery Wealth, thank you for taking the time to listen today, and we'll see you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.